All right, guys, we will go ahead and get started with the group lesson today. Limit orders and stop orders. I've had several questions this week, whether it just be DMs or in group lessons about different order types. So we're going to go over them briefly, and if you guys have any questions, we'll get those answered. And then, again, just like every week, feel free to ask any questions you have just in general. As always, this will be recorded, so you can go back and watch it. This will also be posted on our YouTube. All right, so order types. Obviously, when we trade, we have to buy in and sell out using orders. The three main types of orders we use are the market order, the limit order, and the stop limit order. So I'm just going to briefly talk about what each one is and kind of apply it to how we trade and how we normally use them. So a market order is basically a general order to buy or sell a stock at the market's current best available price. The market order usually ensures execution. So if you really want to get in a trade, if you feel like it might blow past your price target, whether up or down, if you just need to get filled, the market order is going to be the best way to do that. Again, that's going to fill you where the price is currently in the overall market. So if you're looking at the stock, it's going to be the bid. So if you hit buy market, that's going to fill you where the bid is at execution of that order. Now, a lot of times you'll see, and some of you have maybe even experienced, let's say right now I have Snap on my screen, it's at 950. Let's say you click buy market, and in the time your finger clicks the button and the order is executed, this shot all the way up to 10. Well, because it was a market order and executed it when it did, instead of getting filled at 950 like you wanted to, well, now you got filled at 10. And that could have been your entire trade plan, was to trade it from 950 to 10. That's an over-exaggerated example, but that is the biggest downside to market orders. Limit orders is another type of order. This is where you're going to buy or sell stock, basically with a restriction. So you're basically saying there's a maximum price or a minimum price that I want to be filled at. That's why it's called limit, because you're basically saying this is the limit, whether high or low, I want to be filled at. And it will only fill you at that specified price or better. So if we'll do the same example. It snaps at 950 and you put a limit order in at, let's say, 954, it should not fill you below 954. But that's not to say that you might not get filled above that. If you're saying I want my limit order at 954, and just kind of with the market, if it rips really high and it's gonna shoot through your order, well, you place a limit saying I don't want to be filled unless it's at or better 954. So you're going to get a better fill most likely than market, but it could potentially be a little bit higher than what you wanted. So limit orders are safer than market orders. They may, though, not be filled as often, just because there is more of a stipulation, if you will, rather than buy market saying, I don't care what the price is, fill me. And then that leads us into a stop limit order. So a stop limit order is to buy or sell a stock at the market price once the stock is at the specified price, which is the stop. So again, it's a stop limit. You're basically saying there's a limit and there's a stop. So we'll use the same example. If Snap's trading at 950 and you put a stop in at 954, that order should not execute anywhere other than 954. Now, with super volatile stocks, you may see that it shoots through your stop limit and it either only fills some of those shares or it fills the complete order, but with a little bit of a discrepancy in the number. A lot of times you'll see the previous example I just said, it might shoot through your order and only fill some, and that is because you placed a stop and a limit saying I want to be filled at this price, basically nothing else. So when it shoots through that, obviously there has to be buyers or sellers to counter your order. So if there wasn't enough buyers or sellers to fill your entire order, that's when you'll see, and again, you will hear Jason or other people talk about it, and maybe you've even experienced only partial fills of your order. And that is because, like I said, you have to have either a buy or sell opposite of what you're doing to fill your order. And you've placed a stop and a limit saying, don't fill me anywhere else. So if it shoots through that and there wasn't enough orders opposite yours to fill your entire order, well, it's going to honor that stop and that limit and say, well, we can only fill you with 1,000 of your 10,000 shares. Sorry, but that's kind of the limit you put on that order. There's almost never going to be like a negative connotation with a stop limit, in my opinion and in my experience trading. Stop limits are my favorite type of orders. I would say I use stop limits for 80+% of the trading I do. And I would say if I'm not using a stop limit, I'm using a limit. And if I were to put a percentage on market, maybe 10% of the trades I take are market. Typically, if we're using a market order, it's going to be out of like a halt, use a dip and rip or something that is going to move super duper fast, and you probably don't have time to put a limit in. And if you do, it probably won't get filled anyway. So typically, market orders are what we're going to use out of halts. And then limit orders is, like I said, generally what we use if you use Thinkorswim or you use any brokerage that has a ladder. If you're placing an order on the ladder, it's going to be a limit order. Those are probably my most used orders. And then stop limits, again, we're using the ladder. These are my favorite type of orders. Again, you can come back and check this. We are recording it. So if you hover over the tape here, you can see where my mouse says it's buy limit. And that is because my mouse is on the price at or below what is currently trading at. And that, again, is based on the bid and the ask. So it says limit. So if I put an order right here, I'm going to place a limit order. But if I come up here above the price, you'll see it change from limit to stop. This is what we just talked about. I would be placing a stop order. So this order right here, if I place it at 960 to buy, is a stop limit. I will not get filled until that stock moves up to or through 960. So that's just kind of a quick rundown of the types of limit, stop limit, market orders that you can use and that we use. And again, that's just kind of a general application to the way we trade market orders. Usually we're going to use this out of a halt for a dip and rip. Limit orders, basically going to use those, on the tape. If we don't want to buy market, if the slippage is really bad, that's really when limit orders save you a lot. If the slippage is, 20, 30 cents and you hit market, you're immediately down 20, 30 cents per share of whatever you're trading. You can avoid that by using the limit. It's a little more difficult to get filled with a limit compared to a market. So again, if you just want in the trade and you don't care, hit the market, you're going to get filled. Another quick note about orders, as you guys probably know, but if you don't, if you're trading pre-market and or after hours, you cannot use market orders. You have to use limit orders. Does anyone have any questions about order types, how and when to use them? Can you explain why you use market orders out of halts again? Sure. So generally speaking, if we're playing a halt, we're going to play a dip and rip, and Snap's on my screen, so I'll just use it. Let's say Snap gets halted and it got halted at $9. When it resumes after the 5-minute halt, let's say it resumes at 9:50, we usually play the dip and rip, which means the stock is going to open out of the halt. This usually happens very quickly. It's going to dip down. Buyers are going to buy that dip, and then it's going to rip through the level that it resumed at, which in this case would have been 950. most of the time out of halts playing the dip and rip, it happens so quickly that if you're to wait for it to open, see what it's doing, looking at the price action, you're checking the level 2, you're looking at the tape, you have all these things happening. By the time you do all that, it's already dipped and ripped and it's gone without you. And now, you probably shouldn't chase it. You're probably going to have FOMO. Every now and then you will have time to, put in a limit order or even a stop limit order. But generally speaking, if we're playing halts, they're high momentum gappers and they're very volatile and they're going to move very quickly. So if we really want to get in that trade, a lot of times it's going to have to be with a market order. It's unfortunate especially if it's a stock that has a lot of slippage, but you'll hear Jason say, and a lot of traders will agree with, they would rather, potentially lose on that trade than not get in, especially if it's, a good setup and whatnot. They'd rather lose on it than not get in it at all. So market order is going to ensure you will get in that trade. If you hear people say out of halts that, this happened to me, this week, I believe. I tried to trade a dip and rip. I tried to use a limit order, put it on the ladder, rip through it. Basically the same time I clicked, I didn't get filled, unfortunately, and I did not get to trade that dip and rip. So that's why we use market orders for dip and rips most of the time. Market orders scare me. Don't let them scare you. They're the majority of the population that trades uses, market orders. There's obviously benefits to limit and stop limits. But if you have, like Snap, again, just because it's on my screen, the bid is $9.57, the ask is $9.58. There's only 1 cent of slippage there. 1 cent is not much at all. You're not even going to get any less than that. So I would 100% feel comfortable, putting a market order in on Snap. Definitely, before you use a market order, check the bid and the ask and try to see what's going on with slippage. But yeah, I wouldn't be scared of market orders, but they do have their place, and I would prefer most of the time to use limit and stop limit orders. What's the difference between GTC, EXT, and EXT with the TIF? 1 second, let me make sure no one's raised their hand. Okay. So the difference between those is not a whole lot in the sense of trading. The actual definition of GTC, EXT means good till close, EXT, so extended. So the biggest difference between GTC, EXT, and EXT when you're talking about the TIF, and if you're changing either one of those, you're trading pre-market or after hours most likely, is you can put in an EXT order with GTC before it, and you can basically leave it there, and it will potentially fill you all the way through, until close of day. So, in this case, after hours would be, 4 to 8. So if you use GTC EXT, it'll basically keep your order in a way and fill it if it were to, reach that stipulation. Whereas if you just use EXT, you can just put an order in and then, through price action, it's going to fill. I personally don't ever use the GTC just because, if I'm trading, especially pre-market or after hours, it's going to be a day trade and, I'm going to be here watching it. So I don't ever use the good till close extended. Okay, did anyone have any questions on anything that we've gone over in trading this week, or any questions you have, anything specific you want to learn? We have a few more minutes here if you guys would like. We did see some pretty good opportunity in the market this week. Obviously, PGY took off and did its thing. If you were able to catch that, then hopefully you're up a good bit on the week. And like Jason said this morning, that I joined in a hot market, and I mean we literally had PGYs almost every day. It was crazy. So again, we say over and over again, keep showing up and keep doing this and that. When the market turns, that's going to be a lot of days. That's going to become almost the norm. And that's why we really want to, pour into you guys and get you ready for that, because, you got a little taste of it in PGY. It's going to be, I'm not even going to say easy because I don't think I'll ever call trading easy, but it's going to be a little more effortless to make money in a hot market like that. Can you go over what you guys look for when looking at setups? Yeah, so basically we'll just take, a stock we were looking at this morning. All right, so here's TBLT. I pulled this up on my chart. Just generally speaking, I'll just walk you through quickly the day. So, we come in, we jump on our computers and we start looking at stocks. What are we looking for? So the first thing we're looking for is, the big momentum gappers, the leading gappers of the market. There's usually a few of those. So we'll take a look at those and we'll say, all right, what's this pre-market setup look like? And we want to see, hopefully there's a news catalyst, because regardless of what a stock's doing, the catalyst is always going to be, a healthier ingredient in that trade. So we always want to see a catalyst. And if there is one, we kind of dissect whether it's good or bad, how significant is it. Then we want to see what the stock did or is doing. So we want to see a large move to the upside, and then we want to see tight consolidation. So if we're looking at TBLT, and I'm not considering anything else on this stock other than the pre-market setup for today. You saw it was trading around $4, had a large move to the upside. Right here, tight consolidation, market open, boom. That could have been a trade we took. Break a pre-market high. It really kind of took off right before market open, which was unfortunate. That can that changed the trade. So market opened and it broke through 6, went up to 664. Could have traded that, but because we look at other things, specifically the 6-month setup on this, if you look here on the right side of my screen, you just see down, down, down. This was $80, down, down. You see the 200 MA right here, broke through it briefly, continued down, down. This had a low of almost $1. It's continued lower highs and lower lows, mostly trading under, the 200 MA. You can even see right here, we broke through it basically, on a day, came back down. We're now trading under it. It tried to break through it today, failed. So in a nutshell, we want to see something with a catalyst. We want to see a good pre-market setup, which is a large move to the upside and tight consolidation. And we want to hopefully see a good 6-month setup, which looks like the opposite of this. We don't just want to see this entire chart going down for the last 6 months, the entire time. And we want to hopefully see this trading above the 200 MA. Those are all indicators for a potential good trade. Can I go over 5-minute pullback rules? So yeah, we're on TBLT, so you can just pull it up on your chart if you haven't, or again, this is recorded, you can come back and look at it. So this is a perfect example of a bad 5-minute pullback. Generally speaking, if we're trading and we see 5-minute pullbacks, let's go pre-market for this. Number one, we only trade the first, second, and sometimes the third 5-minute pullback. We rarely ever trade fourth, fifth, sixth, however many after that. So the first and second are going to be the best trades, usually the second, and then we might trade the third. We usually don't trade after that. What we want to see on a 5-minute pullback is, if you look at TBLT pre-market, this had 2 large 5-minute candles. This went from 416 to 545 in these 2 candles. So the red candle you can see here opens right here. You can see it goes down to 522, which isn't even half of this red candle right here. So when we see 5-minute pullbacks, we generally don't want to see the pullback consume more than half of the previous 5-minute move. In this case, we're looking at this 5-minute candle right here, and you can see that this doesn't even come down to half of it. and then, the next 5-minute candle opens and this continues higher. And then when market opened, this is a perfect example of a bad 5-minute pullback. This is what we call a bearish engulfing candle. So this was a large move to the upside, 5-minute green candle. This red candle opens under the close of this green 5-minute candle and consumes the entire body of this candle and goes even lower than that. That is a perfect representation of a bad 5-minute pullback. We do not want to see that. And as you can see, after this, it did, try to go up, and since then has continued down the rest of the day. So perfect example there of a bad one. This is a good example of a good one. 5-minute pullbacks are healthy for stocks. Gives people, the chance to take profit, gives people the chance to buy dips, and those are both ingredients to, a move higher for a stock. This is the 5-minute pullback, an example of an ideal entry on something like Snap. Generally speaking, if we're talking about 5-minute pullbacks, it's going to be, the high momentum gappers, small cap stocks that we're trading, things like that. But, if you look at Snap today, just another, I wouldn't even call this a 5-minute pullback. This is just a giant retracement. Market opened, huge green candle, and then just back-to-back 2 5-minute candles completely consuming that entire move, and then had a large move to the downside. Actually made a new all-time or 6-month low at least by a few pennies, and now has bounced. But 5-minute pullbacks can generally be used for most stocks, but we use it for the small cap high momentum stuff. Do you buy in the front end or the back end of a 5-minute pullback? So if let's say we traded a stock, hopefully we made some money on it, but regardless, we traded a stock and now we're waiting for a 5-minute pullback. Generally speaking, we're going to trade, the next move. So if we're looking at Snap went up here to, 980, let's say we traded this 5-minute candle and, we made some money or we lost some money regardless. The next 5-minute candle, we need a 5-minute pullback. So this went all the way up to 985. We're talking about a 5-minute pullback. Came down here to 963. If this was the only candle that did this wouldn't be a terrible 5-minute pullback. It's not a good one, but let's say this next candle opens and starts moving up. You can either buy that dip on that 5-minute pullback for the potential move higher. You can up here, if we're going to trade the flat top breakout, which would be high of day, you can buy a little bit before that to anticipate the break, or generally speaking, we're going to buy that break of all-time high after that 5-minute pullback or high of day. GSHD. EXTR. Great questions, guys. I'm glad we're covering some of this stuff for you. A lot of it may seem basic to a lot of you guys, especially the order types, but they are, very different, and they do have their applications. So I wanted to go over those. I've had several questions. So again, if you have more questions on that, feel free to DM me. Next week, we will definitely do a portion of our lesson will be based on that mindset. So definitely, tune in if you want to see that live. Those, again, like Jason said, won't be going on YouTube. The actual, course itself will be created, and all of that will go into there. So if you want to be a part of that live, continue to join the group lessons. We're going to be doing usually probably once a week until that course is completed. Again, today we went into something else, and we'll pick that back up next week. But great questions, guys. Continue to show up. Continue to bring your questions. We got a little glimpse of, what momentum is and what a hot market may look like with PGY. So I say it every week, but keep showing up. Keep pulling up your charts. Keep paper trading. Keep asking your questions. And when the market turns, whether it's, tomorrow or I pray it's not, but next year, just stay ready and keep learning and keep pouring into yourself, and you're going to be prepared, and you're going to really thank yourself when that time comes. So again, thank you guys for showing up. I appreciate your time. I know it's valuable, and I will see you guys tomorrow morning. Have a great day.